Hi everyone, welcome. As usual, will be sharing with you my views of market, both technically and fundamentally. And well, I will start by sharing the calendar, although, market's attention is pretty much focused on whatever the Fed has to say tomorrow and if they will actually pull the trigger on a rate hike after anticipating it for the last 3 or 4 weeks, right? To be honest, a rate hike, sorry, tomorrow, it's almost a done deal in the U.S. Uh, the Fed officers have been talking about it. Janet Yellen confirmed it a couple of Fridays ago, and last Friday's employment figures were enough to support the move. So here we are waiting for a rate hike. And the thing is that most of it is already priced in, and honestly, market reaction is quite unpredictable. At the same time, there are a lot of other things going on in the market that I believe that are a bit beyond the macroeconomic calendar and beyond charts that we should take care of. One is the late news that came out on Friday afternoon, um, where it was reporting that some uh, ECB members, right, from the government council, sorry, were discussing the possibility of rising rates uh, ahead of the end of quantitative easing, which is supposed to run until the end of 2017, right? Although there was no official comment, there was no date set. Neither Draghi mentioned the case. The fact is that uh, in between the government council, the ECB's government council, there has been always this kind of divergences with many members opposing to such extension of easing we are seeing coming from the first central bank for this last couple of years, right? So now that inflation is sticking higher and things are getting better, these sentient members are rushing to use the word tapper or some equivalent, right? We have no official comments, but indeed it's a rising pressure over the European Central Bank, right? Because of these members opposing the easing program. Still, and despite the news support by the common currency, the fact is that I don't believe that Draghi will give up on easing at least until the end of its mandate in 2019, if I'm not wrong. Still, anyway, he has offered a quite optimistic statement last Thursday. So overall, that's giving a euro a bit of support. We have Dutch elections tomorrow with from French and German ones coming in the next few months. And the risk there is populism, right? That is gaining pace in local parties within the euro area. Uh, all of them opposing to this union, right? As the consequences and the economic developments have been going for bad, for bad, what, almost 10 years, right? It was a nice beginning of the European Union, but ever since then, things got getting worse and worse, and the people is angry about it. And that's why the populist parties are gaining pace in between local countries. So that's the next risk, and we will hear a bit or have a sample of how the European thinks these days with tomorrow's election in Dutch elections, right? And finally, the other thing that is moving the market these days is Brexit, right? The Parliament finally approved uh, the Brexit bill with no amendments because the House of Commons yesterday reverted all the amendments proposed by the House of Lords. So pretty much Theresa May is expected to trigger the Article 50 not longer than the end of this March and begin negotiations with the euro area. In this particular matter, I do believe that now the ball is in the euro area side of the field, because it's at this point it does not matter what Theresa May wants or doesn't want. It's what the euro area is willing to give the country, the UK, after they leave, right? right? And so I do anticipate tough negotiations and the euro area being quite reluctant to offer the UK any kind of benefit, right? And now that the event finally looms, the pound is plummeting, right? Anyway, let's take a look at the calendar. Okay, let me scroll a bit down. Uh, I'm focusing today in the PPI index in the United States because, inflation is inflation. We're expecting a thick in yearly readings, in the core year reading, but not in the rest. However, if we have this 1.5 in year or higher, uh, I do believe that the market will still be convinced that the Fed will act tomorrow, and we need really negative figures in year to deny the possibility of a rate hike. In fact, I don't see how any kind of report today can go against the general sentiments that the Fed will act tomorrow, right? uh, about the Fed. They have been talking so much and for so long about this rate hike coming tomorrow, right? And of course, anything that we will get in the market before it will be pretty much ignored, except probably from the employment figures in the UK. Quite interesting. Usually a big market mover. If wage starts to go down, that will be really bad news in the United Kingdom, and therefore the pound could plunge farther, right? I believe that attention tomorrow will be more focused on wage than any other figure that we may get from the headline or unemployment levels. Anyway, I'm sorry. Back to the Fed, which is the main event of this week. Uh, I do believe that the Fed has been jumping so much about this March rate hike that now not acting tomorrow will be a huge disappointment, and we will see the dollar probably plunging, right? But the fact is that inflation is rising, employment is at the best levels it could be for the Fed to move. And at this point, the Fed could be a bit scared of falling beyond the curve, right? Moving too slow, too late in the rate hike. So the rate hike it's more surely coming. So, and as I said, it's already priced in. So where market attention will be, well, in whatever the Fed says about the future, right? Right now, the market understands that the Fed will give us at least the most three rate hikes this year, March, June, July, December, right? That's the market beliefs. So if the Fed somehow hints that they are planning to accelerate the pace of hiking, right, that will be dollar positive and probably boost the greenback beyond its recent heights, right? But if the Fed hints nothing about the future and let the market trade to believe, there's a big possibility that despite delivering a rate hike, the dollar will plummet. So be extremely careful tomorrow because it's not about the Fed does, but about how the market feels about the movement, how it takes the decision and the statement following the release. Okay. On Thursday, there's a lot of interest in that also because we have employment in Australia alongside with the Bank of Japan monetary policy decision. Sorry. About the Australian employment data, the OP has been trading quite linked to Chinese data lately, but of course, negative figures in here can push the pair, the Aussie dollar pair, below the 75 level, which seems to be the new base for it, right? We have been trading for a month, it between 77 and 76. Now seems that we lower that range to 75, 76. So beware of employment because that's something that can trigger actually the the break lower if of course if they disappoint. And regarding the Bank of Japan, I have been reading some articles ahead of this meeting, and there's a lot of calls of a Bank of Japan needing to buy less than the 80 trillion bonds per year to achieve their new goal, which is not pushing inflation higher, but keeping yield the yield curve close to zero, right? So with yields more stable these days, right, there's a good possibility that it will take the Bank of Japan less than those 80 trillion. There were estimates about 65, 68 billions. So at some point, the market is seeing that as a kind of tapering, right? As a form of tapering. And therefore, the Japanese yen can get a boost also. So there's a lot going on in the market about, with central banks and politicals. But so we will need to hear about Kuroda, which of course is expected to be optimistic as usual uh, before taking a decision of trading. However, I do believe that we are going to see some more Shen strength after this decision. And of course, depending on whatever the Fed did the previous day. I'm not seeing, honestly, I'm not seeing the yen weakening any further. And on Thursday, also, we have the Bank of England monetary policy meeting, probably the less interesting of all, right? The Bank of England is expected to remain on hold. I'm not expecting any change in the votes or in the rates or in the assets purchase facility, and I'm not even expecting changes in in Carney's wording about whatever their outlook for the future is, right? We are not going to get any kind of inflation or monetary policy, economic, sorry. We are not going to get revisions on inflation or growth. So actually, it's closer to be a non-event than an actual event this particular time for the Bank of England. And pretty much that's it for the week. We have not big news coming farther afterwards, right? Maybe the Bank of England quarterly inflation bulletin, but not much more. Honestly, this is a week of central banks. One word about it is that after this events are all digested, the market will jump back to trade politics and probably focus on whatever Trump says or does and on elections in the euro area, right? From a technical point of view, and starting with euro dollar, the fact is that we have been seeing little developments over the past couple of weeks in here. The earlier rally we have seen this, we have saw the major resistance. We have discussed about this 700, 720 price many, multiple times over the past weeks as it stands for the 38.2% retracement of the post-US election slide and a long selling, huge selling interest aligned around it. And here we are retreating from the level and now pressuring a key support, which is 630, as the pair has been capped below it for a couple of weeks, right? Meaning selling interest, former resistance, now support. The short-term technical picture favors a bearish extension, but limited. We have 600 as 590, most likely as the next support, followed by this 550-60 region where the pair has been struggling for also a couple of weeks, right? And below this level, then the risk gets further lower. 520, 490 seems next. To the upside, we have set a daily high today around 660. That's the immediate resistance ahead of this region I mentioned, 700, 720. It seems unlikely we will see price breaking through it anytime today, right? But well, anything can happen tomorrow with the Fed. So beware of this level, as I do believe that a break and a settlement above it could favor an upward extension up to 820, which is the 50% retracement of the same decline, right? And for the pound, well, we are trading at fresh 7-week lows, right? As fears of a Brexit loom, what we have commented at the beginning of this live coverage webinar, right? So here we are trading at 21. I was watching bigger time frames, and to be honest, there's not much in the way until 2035, 2040 region. We have the high closes opening up, and that's the next relevant support for me. So if we take 21, there's a good chance that the pair will fall down to that level. And of course, once below it, will probably complete a 100% retracement towards January lows at 1986. Okay, so that's how the levels are watching. If somehow the Fed manages to trigger a dollar rally, okay, uh, and the pound seems to be one of the most vulnerable and most uh, willing to give a larger amount of pips on a decline. So a stronger dollar, I will trade the pound dollar, and on a weak dollar, I will rather take a look at the dollar Japanese yen, right? Anyway, and towards the upside, there is a short-term resistance around 2160, but the 22 level is the most relevant one, the first relevant one we have ahead of this area, which is 2260, also a major Fibonacci resistance on the level to surpass to see the bearish pressure easing. As long as below this level, an approach and even approaches to this level will probably keep attracting selling interest. Uh, I don't see how the pound can recover beyond that level, although the extreme oversold conditions we are seeing these days could trigger an interesting upward corrective movement, and the Fed could be the excuse the market needs to do so. Okay, and when it comes to dollar Japanese yen, we have seen some recovery in here. Let me change the daily from Fibonacci to Fibonacci's. But the pair seems unable to regain the 15 level, right? We have a peak around 1495 from mid-February, and attempts to advance beyond this area seem hard to achieve, right? And well, we have that 1550 highs area, which is now the level to surpass, to somehow confirm that the pair has broken finally and finally recovered the 15 level. Overall, technicals favor an upward move because the price has held above this, which is the 100 simple moving average, but there's not enough momentum, and since the market is not actually willing to buy at these levels. Of course, as usual, ahead of a big event in the US, the pair is trading range bound, and the situation will probably continue until we have the Fed, right? The 1450 area is the first support, right? Followed by 1390, 1410, quite a congestion area. And I would say that below 1317, 1360, the chances then turn back towards downside with scope to test 12 in the upcoming sessions. Okay. As for the OC, as I was saying, the pair has been trading for almost 4 weeks between 76 and 77. And now from the previous week and this one, the 76 area, it's capping the upside, right? But still, there's not a real trend going on in here. Pair is pretty much flat, pressuring the lower end of its range. And as I said, we really need to see a breakthrough 75 to talk about bearish extension. That anyway, I don't expect too long for last, and I'm not seeing the pair falling below 72.50. For me, 72.50 is like a line in the sun. We could see a bearish movement down to that level, but honestly, I would expect a nice bounce if that level is reached. In the short term and for these upcoming sessions, the downside seems quite limited. Take a look at the forward charts with indicators having corrected over both conditions and regaining the upside, and the price bouncing from its 20 simple moving average. So overall, downside potential is limited, although further momentum came only on steady break above 76, right? 76 is the first resistance. Above it, 76, 30, 40 area is the first probable bullish target, and followed by 76, 70, right? And of course, 77 area, right? And I was taking a look at this 75.40 region as being immediate support. If we break below it, the pair could probably go back towards its recent low around 74.90 and below that, I would expect the downside to accelerate. 74.20 seems a probable bearish target in the year. Okay, gold, poor gold has been on a tear ever since topping around 1216 mid-February, and here we are with a big downward corrective movement. I was following in the daily chart the breakthrough this 38.8% retracement of the latest bullish run and the level capping the upside, but the price also holding above its 100 simple moving average, right? Anyway, after this downward corrective movement, we have entered in a wait and see situation, to be honest. Um, Much of gold behavior has depended on the Fed, but I don't believe that from now on it will only depend on the Fed sentiment. It's also taking its toll on the commodity, elections, central banks, everything that's been priced in gold, and that's why we are not seeing much of a directional move because risk events are favoring the upside and the Fed is favoring the downside, right? So the market is not yet ready to break any kind to break any extreme and and take a certain way. It has to be a really hawkish Fed, right? We need to see the pair breaking through 1193, which is for me the first and immediate most relevant support, the 50% retracement of this latest bullish run, and see the commodity correcting lower, right? 76, it's the next bearish target, and below that level, I'm not seeing it breaking through towards these lows, but at least some other 20 bucks and falling down to the 1150, 55 price zone. That's a probable bearish target. And honestly, as I said, with the risk averse environment we are having these days, the most likely scenario is that if we fall this low, the commodity will probably bounce, right? On the other hand, if the Fed disappoints and we go through this high at 12.11, then the commodity will probably recover further. 22 is my first bear bullish target, followed by this area around 12.13. Okay. And when it comes to oil prices, the fact is that the commodity finally gave up. It broke its 50-55 range towards downside. A huge year's stock price reaching record heights, historical record heights, continued increase in production, continued number of active rigs in the US are favoring uh, the commodity towards downside. And the fact that the OPEC is not fully compiling, despite whatever comments we have with their output cut promised last year, are keeping the commodity on the negative side. To be honest, I believe that the key on whatever will happen here we're going to get tomorrow. If the report shows that US stock price rose again, uh, it will be, if I'm not wrong, the ninth consecutive week, and that will send total crude stock price to fresh all-time highs. Then the commodity will probably extend its decline, and at this point, it will take a break below 48, right? Not much far from where we are, to see that the commodity falling down to 46.30 first and 45, 44.80 then. The 45 level is the next big line in the sand, so I don't expect it to fall below this level this week, but probably end it closer to it if we have more news of increasing production in the US. And towards the upside, it seems quite limited right now. First threshold is 49, which is the 200 simple moving average, and above this level, well, maybe the recovery can extend up to 50, but I'm not seeing much of case for an advance beyond 50 these days. The market is unwinding. The longs made late November, and I don't see how news converts course in oil these days. Okay, okay, okay. That's it for today. I hope to see you tomorrow in live coverage with Joachim and Mauricio for the Fed. So thanks for bearing with me today. Not an easy day, not an easy week for me, this one. Thank you. See you tomorrow. Bye bye.